Hi, welcome to Tabs 2 Cents. Today on the show, we have Shubham Garg from WhIte Tundra Investments. We're talking about oil. Hope you enjoy the show.
Welcome to Tabs 2 Cents, the show where we discuss multiple income streams and macro factors affecting the world today.
Hey, Shubham, welcome to the show.
Hey, Joe, good to be here again.
Yeah, thanks for coming on. It looks like you've been progressing along with your business, WhIte Tundra Investments. How's that been going for the new year so far?
Good. WhIte Tundra has been good. We have been focused on quite a few things here recently. I think the last time we spoke had a pretty significant public equity positioning. In the meantime, kind of transitioning more into some of the junior names at this point. I believe that some of the macro oil and gas macro has been getting clearer past this sort of SPR and Russia and China COVID blur, if you will. So as the macro continues, I think there's opportunities to move down market without taking on any extra risk. And in fact, some of the valuations are even better than some of the small to mid cap players that I was in and continue to hold, which themselves are trading at exceptional levels. So kind of just shifting strategy there a bit. And then as well as that, moving into some private placements. So we've done two now, I believe, since we last spoke. One is a private producer in central Alberta. That's kind of developing a new way of fracking into an existing known geologic formation. And the other one, which was just announced yesterday, was a placement into Prospera Energy, a public medium to heavy oil producer. So no, things are fantastic. Having still going to continue my Sunday sessions. So moving more into petroleum engineering topics this year. Last year was valuations, companies, junior company deep dives, and all that. This year is more on like basin specific information, engineering topics, enhanced oil recovery, and talking about multinational companies' growth plans. So just more overall broader topics to get people, just thinking outside the box a bit, more so on macro plus the company side.
Oh, that's awesome. So when you're looking at companies, do you tend to go for, the best deal, the cheapest valuation, or the most efficient, best oil producers? Or are you looking for more innovators, like new technology type deals?
Yeah, you bet. So we had a kind of interesting experience with the call it a private placement that I did back in March of last year, where the geology was really good, but the management was just not up to the task. They were not good technically, and they were also not willing to collaborate. So kind of learning as I go through this cycle, of course, as well. This is my kind of first time going through this. So lots of pros, lots of cons, but I think the one thing that has to be there is good geology. No matter who you are, you cannot make bad rock work, even in a, call it a really, really good oil price environment. The companies with better rock will just absolutely destroy you. So the geology has to be good. Management, I like management these days that I can work with. They don't have to be the most accomplished, the most track record managements, but ones who are open to discussing ideas, ones who are open to kind of explaining what they do. The more technically focused they are, the better, I think, in my opinion, as long as me and my team can also verify what they're saying as well. So kind of technical, then we look at the management side of things, and then we look at valuation. So am I gaining by going down market? That's what I always ask. And when we say gaining, there's two aspects to it. There's risk and there's reward. Most of the time, the reward is usually higher, because the more junior companies, small cap companies trade at lower valuations. So if you run a certain price deck going forward, you'll say, okay, we have more reward in these names. There's potential for more upside. And I think it's the more of the risk part of the calculation that is being misunderstood. People see a company trading at 20, 30, 40 cents. They see X amount of shares, and they say, oh, this thing is completely risked. It must be a high debt junior. That's a coin flip. And people are just not doing the work. These companies, some of these are debt-free companies. Some of them have really, really strong assets that haven't been capitalized for many, many years. Some of them have very strong backing from their debt holders, from large equity shareholders who have continued to support the company. So I think the risk portion, the risk portion, I believe, is being misunderstood. And there's certain companies where I see, hey, we have more upside by moving down market, and also the risk is either the same or lower, especially the geologic risk. So we take all that, we put it into sort of this. There's no calculator. It's more of a subjective art, not a science. And we say, yeah, these companies make sense to invest in, and that's how I do my portfolio allocation. Of course, position sizing is of the utmost importance. Junior companies don't have the safety net if something goes wrong, like a major spill, they have a major pipeline break, anything like that. So always be cognizant of that. And then, just risk tolerance as well, right? The way that I run my portfolios, I have a much higher tolerance for risk than maybe the average investor, even in the oil and gas space. So so I just I guess take all of those, make a decision, and then we decide on position sizing and kind of run with it. We're not investing in these companies as a flippers or trying to scalp sense. These are businesses, and one of the things that maybe in the commodity space, some of the people that are new have to change their mindset around these, that you're not buying what is right now, you're buying the business and their business plan for the next 12, 18, 24 months. So I believe Stanley Druckenmiller has a really important quote about this, that when you're buying commodity based businesses, you have to look and have a vision for what this company ends up at in the future, as opposed to XYZ is wrong with it today.
Wow, that's really interesting. So a long-term hold, long-term mindset with these guys. And what I found interesting about that is when you first start getting into investing, everybody says, oh, penny stocks or stocks that are valued at pennies, let's say, 15 cents or whatever, those are ultra high risk. But from what you're saying is perhaps if you do your homework, they aren't. And also you can, reduce some risk by holding long as well with a lot of companies. It just it raises a question for me in oil and gas production. How does scale come into that? Because the scale, like, you can't really compete with Walmart in retail, but in oil and gas, how does it play out with scale?
Yeah, so fantastic question. Scale drives cost efficiencies. It drives savings. It lets you get better deals on debt. It lets you have a lower cost of capital. It lets you have access to possibly more qualified board of director personnel, because you are able to kind of bring them into these bigger companies, and also able to compensate them properly for their sort of information and edge that they bring to the company. So there is a definite edge to being in bigger companies. But I look at it a different way. If we are in a structurally bullish oil market environment, which you almost have to believe that if you're in the oil and gas space anyway to some extent, then let me put it this way. The companies that don't have scale will get scale. And there's a wedge there that is an additional bonus to your cash flow, your free cash flow. Your operating cost per barrel might come down from $30 to $20. That $10 per barrel wedge is the same as if oil price went up $10 a barrel, because you're getting an extra $10 a barrel of netback. So to me, I see it as an opportunity that companies that aren't quite there yet, they're still building their, production base, they're still growing, they're still finding efficiencies in what they do, is a double whammy for me. And you see this proven out in many companies over even the last couple of years. You look at the 2008 to 2014 sort of range, many growth junior companies were doing the same thing. So when I look 18 to 24 months out, I say operating cost today is this. When the company is 3x, 5x the size, operating cost becomes this. I get an extra net back. In the meantime, yes, I have to pay more because we don't have the scale. So we have to compete with some of the bigger producers who have been able to pay back debt much faster, who have been able to have bigger dividends much faster, buy back their shares much faster, because they already have the scale. They already have the efficiencies. When oil prices averaged $95 a barrel in 2022, they got the full advantage of that. And they took that extra cash and they did whatever they wanted to do with it, whether it's acquisitions, buybacks, et cetera. And I guess just to your earlier point, I'll put it this way. Athabasca Oil was in the under 20 cent range in 2020. It's one of my biggest wins, so far in my investing career. Journey Energy last year was under $1.50 or so at some point. And not last year, in 2021. It was under $1.50, and people said this is a complete junk. We don't know this. What's happening turned out to be one of the biggest winners. Last year, a company like Rock Resources, 20 cents, 18 cents, they did a raise with warrants. People said, we don't believe this. Yeah, management is underqualified. Rock Resources was a top TSX or TSXV performing oil and gas name last year. So where there's, if you're willing to do a deeper dive into these companies, I'm not saying buy every single thing under 10 cents, not by any means, but if you're willing to do the work, look at the technicals, look at the management, there's hidden gems out there that are completely mispriced, and all it takes is time to prove out the value.
Yeah, I think that's a really good point. You're getting in on these companies early, so they're not quite as efficient, but as they grow, they'll gain that scale, and then perhaps you'll start to see that coming back in the income statements. I think that's a great point there. Which brings me to a question I wanted to ask you is, for somebody who's sort of, new to the space, they're coming in, what would you suggest they like to look at when they're building an oil and gas portfolio? Like, say you're looking at, 5 stocks, you don't want all the same type, I'm assuming. So, how would you diversify within that sector?
Sure, yeah. So I would say before anybody spends any time looking at any oil and gas companies, I would spend a significant amount of time on the macro. Understand what the macro is, supply, demand, inventories, figure out what are the main bear cases against oil, and figure out what are the pushbacks to that. So the recession bear case, the EVs are going to kill oil demand bear case, the windfall tax bear case, right? Understand those risks, understand why they might already be baked in or how we're dealing with these risks, and then have a clear view on where oil prices are going. If you are going to be running sensitivities saying, I want to downside protect myself to $50 oil, but I also want upside to $120 oil, you're going to end up with this mishmash of companies where you're going to get pushed out of names because of the inherent volatility. You may not be fully understanding what you're buying. So spend time with the macro, have a very defined range where you see oil prices going. And yeah, if you want downside protection, there's names that fit that. If you want upside torque, there's names that fit that. And then just buy, 3 or 4 or 5, as you said, you want to build a portfolio, you buy those top names that fit that bill. Some of the companies can be very similar companies. Like, for example, my top 5, when I look at my portfolio, are all lower decline producers with huge net asset values that are not being reflected in the stock price. They have very, very large tax pools, which gives them 2 to 3 years of runway that while things are cheap, they're able to buy back shares. They're able to pay dividends. They're able to make acquisitions. Whereas their peers are paying a 23% cash tax on their, call it net income or free cash flow, whatever number that ends up being used, right? So there's an inherent advantage, and all my companies are like that. They have exceptional free cash flow, they have low capital requirements, and they have runway to growth. So, again, I'm not paying what the company is doing right now. I have this vision, and if the company has a runway to grow, maybe not right now, maybe in 12 months, maybe in 18 months, now they come out and say, oh, we have this untapped acreage sitting right here where we can grow another 10,000 barrels per day or 5,000 barrels per day. Investors would like to see that possibly, let's say 18 months from now, oil is $100 a barrel, the strip is 95. Now all of a sudden investors say, we want growth. You want the companies to already have assets and packages and land, as opposed to them panicking and then going and buying stuff when things may have already re-rated. So I'm saying a lot of things as to like what could or would or may happen, but you have to think that way in the oil and gas industry. Looking at valuations today and running any sort of sensitivities is just wrong, because the strip pricing has never been accurate. All the strip pricing tells you is, are we in backwardation or contango? And what is the price that I can hedge at? That's it. It doesn't tell you anything other than that. So I think having a more full-on mindset around it is really important. And I think what you end up finding in the oil and gas space is people either are not in oil and gas, or they have 50, 70, 80% of their portfolio in oil and gas, because it takes so much time and effort to understand the industry and be happy or content with the volatility, that you either get completely shook out, or you say, I'm going to spend the time, I'm going to learn the industry, I like the valuations, and I'm in it for the next 2, 3, 4, 5 years, kind of thing.
Yeah, I completely agree. I think the macro is what keeps us here, and it just builds that confidence in the companies you own. So why don't we dive into that a little bit? I thought I would start with macro, just kind of ask if there's anything you learned from 2022 in the greater picture, and are there any lessons there that you may carry over into this year?
For sure, yeah. So I'm actually going to be discussing this more in detail on my February 5th kind of 2022 review presentation. Haven't really had the time to really think about it properly, but I think a couple of the things are that the market moves quick. If you are not prepared and paying attention, the oil and gas market will completely humble you in a matter of 2, 3, 4 weeks. So really have to be paying attention, have to be following your equities, even if not, like, I'm not saying watch it from 9:30 to 4 every single day. I'm saying just keep an eye on them, keep an eye on the macro, any major changes. Last year we saw Russia, we saw China, we saw the SPR, we saw Libyan barrels come on and off the market. So 4 major things that happened last year, and they all happened at very similar times. So kind of looking at these things, understanding their impact early, and making a decision as to kind of, do you want to hold or do you want to sell, sort of thing. So, or buy, I guess, yeah, all 3. So that, I think, was one learning. The other learning was, there's a lot of people, and this could be just because I'm on Twitter, but I also notice it within friends and family that are in the oil and gas space, is a lot of people are not convinced. They're not convicted. They still think oil and gas is, even though they have investments in it, they still might think it's on its way out. They're spooked by every news release. Every single time something happens, they're like, what's the downside? What's the downside? And people don't see what the upside case is. What if China reopens way faster than it ever has before? What if Russian barrels one day completely drop off, 1 million, 2 million barrels drop off? What if Libya gets into civil war and 1 million barrels a day drops off the market just like that tomorrow? I don't see people asking me these questions. So one of my biggest learnings was, people are skewed negative always on oil and gas investments, compared to something like a Tesla or Amazon. It's like, oh, we're going to take over the world. This is like a given. They don't want to talk about the negatives. It's like, oh, we're going to have EVs 100% by 2035. Why are you even questioning this, right? So the different sectors have different bearish skews and bullish skews. And I think the oil and gas side has definitely a negative skew. So you have to think about that. That's baked into the way these companies trade. And so if you don't have that skew, maybe that's an opportunity. And that's the way I put my money where my mouth is, with my investments. So a couple of learnings there. I think lots of things happened in 2022 on the macro side that nobody had a good idea on. We were all waiting for the data to come in and then figuring out how it made sense. So a couple of the learnings there, and I think as I get more time to reflect here over the next week or two, I'm going to really be thinking about some of the other things how I've made adjustments, because some of the things happen subconsciously, and then you later realize, okay, this is what happened. So I think 2022 was a fantastic year for a lot of oil and gas investors, and I think 2023 is just gonna continue that party, because a lot of the call it the issues that we had in 2022 have been resolved for the most part at this time.
Yeah, that's a really interesting topic because like fear is what I'm talking about. Because even with podcasting, like, and I've talked to lots of people about this, if you put a big banner fear on your thumbnail, like you're more likely to get clicks. And you just come out with a news article like the stock's going to tank, everybody's going to click on it. But you come out with a bullish article and you get a third of the clicks. So I don't know why
Sure.
that is. It's just human nature. We like to be afraid, or you see fear and you want to learn if it's going to hurt you or whatever it is. But
Right.
certainly with certainly with oil and gas, it's very prominent that way. It seems like people see an electric vehicle and they're like, oh, it's going to take over, even though there's one out of every 50. But anyways, just moving on, like with with 2022, like as you said, China was a big story. And
Mhm.
what I noticed from that was that everybody seemed to look at China in a inflation or deflation view. So they're saying, is there going to be a, commodity demand and create more inflation, or is, perhaps supply chain increase, the output from China, maybe that'll be deflationary. But to me, both of those things are bullish for oil. You either get China sucking more commodities, or you get China pumping out more goods. So, more ships and all of that kind of stuff. I guess the only downside for China would be is if they go into a recession. But I don't know. I just thought I would ask you what your view is on China and all of that macro stuff.
Sure, yeah. So China is the world's biggest energy consumer. There's countries like the US that consume more oil, they consume certain other products more than the other. But when you look at almost every single base metal, almost every single construction material, every single source of energy, China is the world's biggest economy. So as they reopen, there is going to be inflation just from them sucking in all this goods, for sure. So they're going to be pulling on the base energy cycle, energy being sort of what goes into everything. So there's naturally going to be inflationary forces to that. China's reopening, I think, is going to shock a lot of people. They keep comparing numbers that in 2019 we were doing this and that, and they fail to mention that China, going into 2019, oil consumption was increasing by 600,000 barrels a year. Their internal, call it airport and airline consumption, was rising not exponentially, but still at a pretty high pace. And the fact that they're selling 25 million vehicles every single year. So all that has to come back. There is a pent-up demand aspect of it that we saw in the US, that we saw in other parts of Asia, that is also going to happen. And the fact that China is not just China. The business activity and travel activity within China affects Japan, Australia, New Zealand, Europe, US, Malaysia, Indonesia, the Philippines, Vietnam. I could go on and on. And one of the big data points that I can give you for that is that the average Chinese traveler that leaves China, the average Chinese traveler in the US spends 3 times as much as the rest of the travelers, and how much they spend on a visit to the US. So you can't just look at it in terms of population terms. You got to look at it, what is the overall global economic impact? And there's going to be a lot, because I believe China is moving from a production economy to a consumption economy. So they're buying more vehicles, they're buying more TVs, they're buying more refrigerators, they're building more bigger buildings and skyscrapers, they're building airports, they're buying airplanes. So as that happens, that's 1.4 billion people moving into consumerism. So, how's it going to play out in terms of global inflation, deflation? I think it's inflationary, because not only is China consuming more energy in order to produce goods for the world, their own internal population now is becoming a consumerism economy. So there's a global kind of pull on demand-based pull inflation that's happening on not just petroleum products, but like everything in general. So that's how I see this playing out. The data supports it, the overall mindset supports it. And the people that are arguing against this are using data points that are 50,000 foot looking. They don't have the exact data on what's happening. They just say, oh, the population went down by 1 million. Okay, the rest of the population, 1.4 billion people, are consuming way more energy per capita than they used to. And that's been a steady line over the last 20 years. So they refer to one like weird point on the side that doesn't really tell you the full story. So when we look at, and I can talk about China for a while, so just stop me when you have to. But there's certain cities within China that, okay, they're up 10% petroleum demand versus 2019. I can show you cities where the traffic congestion index is up 600% since 2019. So again, if you look at a 50,000 foot view, you say, oh, the population is declining, people don't want to consume and all this. The localized one by one modularized data will show you that what's happening behind the scenes is that country is growing. They're growing substantially. They're building new international airports. People are buying vehicles by the millions per year. People are buying motorcycles. People are buying barbecues. They're building roads. And they're consuming every single power source: oil, natural gas, coal, LNG, hydropower, solar, wind. They are the leaders in deploying these things and consuming these things. So on the overall, anybody counting China out is, just looking at things from the sky, and they're saying this. Well, go into things on a deeper level, and you'll see the consumption that can come out of that economy is just insane. Like the world cannot even afford to have China get to the levels, some of the levels that the average Chinese consumer may want, because the American and the North American and the European consumer might start to get priced out of energy, which we're already seeing, right? The people are getting priced out of natural gas in places like California. People are getting priced out of able to buy gasoline when prices went up there last summer. So it's all happening all at once, and I just look forward to see how it's all going to play out, because the other big factor now is India, and I'm not going to go into it, but that's another massive population. Air India next week, if this is correct, next week is going to announce the biggest airplane order ever. So you would think it would be a United or a Southwest or a Delta or a Etihad or a Emirates. No, it's Air India. 495 jets are rumored to be ordered all in one order. They wouldn't be doing that if they thought oil and gas was on its way out, now would they?
Yeah, and it's obviously jet fuel is, one of the main contributors to the oil demand. And it's interesting you brought up India, because I actually have India written down right after China. And another thing that I have written down is, I just wrote it down as a job note: emerging markets and who, because this is what you typically hear as demand goes down in Western nations, the emerging markets pick up that demand, and the oil supply remains tight. So, when I say emerging markets, what comes to mind for you?
I think China is number one. India is number two. Southeast Asia is your number three. And then I'm going to lump these all in one, and I'll tell you why. Nigeria and the Middle East are sort of 3A, 3B, let's say, with Southeast Asia. So China, we've already discussed. India, building 9,000 kilometers of highway a year, building 10 to 15 airports a year. Again, selling their vehicle sales are just rising now. They haven't got there yet. Still picking up, but rising very fast. Their motorcycle sales are looking really good. The overall petroleum consumption is looking strong, and the government's giving out massive infrastructure bills, huge subsidies into getting these projects going, bridges, skyscrapers, building business towers, areas like that really allow people to then be in this like globally connected thing. The internet, what do you call it? The number of people that have access to the internet is rising really fast in India. So what took China 20 years to do, India might do it in 10, 12 years. So all these things, I mean, we're still watching the data as it comes in. A lot of the data or petroleum consumption within India is diesel so far, and that's looking strong, but we're watching for the gasoline number to now start rising at a very, very fast pace, 12% per year, roughly, let's say. I should have better, more accurate numbers on that, but I think it's 10 to 12% per year that we're watching for gasoline. And then Southeast Asia, the Philippines economy just grew. Yesterday was posted 7.2% in Q4 last year.
Wow.
Well, you told me federal funds rates are going up. People told me the stronger dollar is going to destroy emerging markets. They just grew at 7.2% in Q4. So these emerging markets are hungry. They are determined. Their governments are supporting them. So Philippines, Vietnam, Malaysia, Indonesia and Singapore are like already pretty modernized, but there's still large parts of the population that want petroleum products there. So I'll clump that all into one, because all of those are going to benefit greatly, including Bangladesh, from India and China's dominance and wanting to build more inter-country connections as kind of time goes on there. Big in the textile manufacturing, in the semiconductor space, in the overall kind of just business tourism. Where are the Indian citizens going to travel to? Well, somewhere close to them, right? So that's Southeast Asia. And then the 3B is your Middle East and Nigeria. These two countries have massive populations, or area and a country have massive populations that are quite heavily subsidized. And they're also oil producers. So when oil prices are higher, these countries do really well in terms of the money coming into their coffers. You can run something like a Saudi Arabia or UAE. Look at their GDP growth from 2010 to 2014, and then look at their GDP growth from 2014 to 2020. It's a tale of two worlds. Why? Oil prices. That's it. There's basically one factor there. Yeah, there could be other secondary things, but for the most part, it's oil prices. So as we now go on, I would not be surprised to see 8, 10, 12, 15% GDP per capita growths in these countries. And guess what? Petroleum is subsidized. So people there are paying 40 cents a gallon, 40, 50 cents a gallon for fuel. And what are people going to start buying? They're going to start buying vehicles. They're going to start using their discretionary income on these things. They're going to have better paying jobs, because the country just is going to have more construction. It's going to have more global business development, more tourism, more IT, technology, whatever. And as people get higher paying jobs, they want leisure activities, which is travel, buying bigger homes, buying vehicles, consuming gasoline and natural gas and other things. So it's a X factor that I think the world has almost forgot, that global oil demand was growing million plus barrels per day from 2014 to 2020, with these large populations in these oil producing countries effectively stunted and flatlined. So if that changes, and India and China continue to grow, and Southeast Asia continues to grow, yeah, watch out, because some of those higher price WTI calls that people are right now laughing about and making jokes about may be coming to a screen near you sooner than people expected.
Yeah, for sure. You never know what's going to happen out there, and everything you said makes sense. And that's the hardest part with this whole deal is, totally makes sense, and then somebody can come on with the bear side, and that makes sense too. And it's just so hard to decipher what you think's going to happen. But you really brought up a good point with the US dollar. I wanted to ask you about that as well, because let's game it out for a minute and say this isn't as inflationary as it could be. The the rates are going to have to stay high. They may even have to hike further, and that's going to create a strong dollar. And then, of course, that's going to make oil expensive for other countries. So, how do you see that playing out with, a high US dollar?
Yeah, for sure. So I think the US dollar, I don't want to make a case on where it's going, but let's assume that it's going to be going higher because of the factors you mentioned. So I don't think the emerging markets are affected because their own internal GDPs and their own internal income per capita is going up a lot faster than how the oil priced in USD has changed. Now, natural gas is a bit different because there's other factors why Europe and Asia pay way more than America. I'm talking about oil, strictly oil and petroleum products, liquid petroleum products. So they're not as affected as maybe people were thinking, and we see this in some of their summer 2022 GDP numbers. The other factor is that petroleum got to 100 million barrels of consumption for a reason. It is so damn efficient. Like a farmer somewhere in South America, in India, that converts from using manual labor to now using diesel powered tractors can farm 10, 20, 30, 40 times the land that they had. So and much faster, and with no safety risk, people getting injured, people getting sick, people leaving their job, whatever happens. So it's more efficient, it's more effective, it's more reliable. And in some cases, 5, 10, 15, 20 times more efficient. So even if the price goes up 20, 30, 40%, now you're competing against something that's 5x at least more efficient. So the numbers always add up to more petroleum consumption as long as people can kind of get to that level to afford it, because that allows them to make more money. It allows them to just become bigger at what they do. It allows economies to become hard GDP economies. So this is one of the factors. I think that's really important. The underlying cherry on this cake is that many of these countries that are non-petroleum producers often have massive tax on the petroleum products. India, for example, almost 50% of the price of gasoline is tax. So as the country consumes more, and as the the governments want to support the development in these countries, they have a massive, huge chunk there that they can slowly eat into. And let's say 50% of, call it, million barrels per day of gasoline consumption in India. Once that gets to 1.5 million or 2 million barrels per day, the government only needs to tax it at 25 or 30%, and they get the same effective absolute dollar coming into their revenues. So there's a natural benefit from that way as well. And we saw Japan doing this. We saw some of the European countries doing this. We see some of the other countries in Asia that are doing this. And India as well cut their gasoline tax quite significantly last year. And I think that just continues as time goes on. They're not going to slow down their economy if they can give up a little bit of tax revenue and make up for it in the quantity and GDP generation, which just leads to more tax revenue. So the whole system just works better this way. Yeah, in my perspective, and you're seeing governments execute on this. This is not me saying this as it could happen. It's already happening as we speak.
Yeah, that's really interesting. I think the general consensus usually is as the US dollar goes up, crude price goes down because, it gets more expensive and people can't afford it as much, and there's some demand destruction from that. But it sounds like, the macro point of view here is we could maintain a higher, $80 a barrel even with a strong US dollar.
Right.
And yeah, just moving on, one company that I wanted to bring up is MEG Energy. And I look at MEG because it's your 16% largest holding in your WhIte Tundra Investment account. And it's also held in the 9 Point Energy Fund, which is Nuttall's account. And I find that interesting because, you guys are both, big in the oil space, and I like listening to what both of you have to say. And he was talking about Meg's reserves, and he said it's something ridiculous, like 36 years of reserves that they have.
Mhm.
And I just wonder if you could talk a little bit about Meg and why you like them as well.
Yeah, sure. I could talk about Meg all day long. So it's such a simple company to understand. They have one asset that they spent 5, 6, 7 billion dollars on in kind of the early 2010s, let's say, for argument's sake. There's decades of SAGD technology that people, research, spent hundreds of thousands of hours on to get to where we are in the oil sands. And the company is already operating. So the asset's already operating. They have about 35 years of what we call 1P reserve. So reserves that are proved and proved developed and proved undeveloped. And then they have another 20 years on top of that of probable reserves, which means there's over a 50% chance that these reserves do exist and can be produced. So 35 years. Now, what's the way these calculations are ran, and why is Meg not getting the full benefit? Because how do companies like to run things, banks and whatnot? They'll say, okay, you're producing this much cash flow. We'll put a 10% discount on future cash flows. We'll put, actually, because we think oil is dying, we'll put a 15% discount on your cash flows. Oil is not going away in 6 years. But when you run a 15% DCF model, everything past 6, 7, 8 years effectively becomes worthless. So now let's flip that on its head. In a world where oil is getting harder to find, the exploration success rates are going down, inflation on new developments is skyrocketing. We have less and less CapEx that's being put into the ground in the oil and gas industry. Any projects that do want to go ahead, we don't have the labor, we don't have the supply chain, proper parts, and we have constant, headwinds from ESG, from environmentalists, from the First Nations in some cases, not in all cases, in some cases, that can slow down projects. Any project that's already built and producing should be worth way more. So when I run my DCF models, I run 5% discount rates, in some cases even lower than that, because oil is going to be around for the next 35 to 55 years, which is the reserve life of MEG. And I think oil, as time goes on, becomes more valuable as opposed to less valuable, especially projects that are already producing and have the reserves. So when I think about it that way, I buy MEG and it's down, like, not that it's down from when I bought it, but the volatility around it means it could be down 20% in 2 weeks, and then it could be up 30% in the next 3 weeks. So as long as I can live within the volatility, I know what's coming on the other side, which is that people will realize we're in an energy scarcity cycle. You could have a recession. What happens on the other side of the recession? Did half the world's population just die in a recession? No. So on the other side of the recession, oil demand continues on. We don't have the supply. Projects that are already producing barrels and have decades of reserves are more valuable. And the valuations will naturally just come back into the equation. And in the meantime, they will come up and say, hey, by the way, we have very little risk now because we just paid off 75 to 80% of our debt already. We're also buying back almost 10 to 15% of our float every single year. And we also could pay another 5, 10, 15% dividend on top of that if we really wanted to. So when I see companies with this sort of runway that are so easy to explain, that are so easy to understand, it's one asset, it's one project, they're about 8 to 10% above their production numbers from last year even, and just looking fantastic. They're saving interest by paying back all that debt. All that interest comes back into free cash flow. So very simple company to understand, and they're not doing anything that's going out in all kinds of different places, and you have to explain these things. It's just, I keep repeating myself. It's just so simple. And for the portfolio that I run, which is a margin portfolio, I want assets with no geologic risk. I don't want to have to deal with any sort of CapEx exploration risk. It is what it is. And it can stay there for many, many years. And I'll give you a visualization sort of exercise. When Husky first made an offer for this company in that would have been 2018, about summer 2018, Husky Energy made an offer to buy MEG. It was roughly priced at $11 a share at that point. But the company had way more debt. So $11 per share plus the debt on top of that. Now, because it paid back that debt, the same enterprise value is now about $22 a share. So if Husky was willing to pay what is now $22 a share, back then when oil prices were $65, $70, we're starting into a macro cycle that's much, much higher from here onwards. And the supply isn't there. We have much better data on OPEC's spare capacity. We have much better data on US shale and how it's kind of flatlining here. We have much better data on world demand. It continues to go up despite EV penetration and all this. Sounds like a pretty compelling case to me. And there's a reason it's my largest holding in my portfolio.
Yeah, I think that's a good overview of MEG there, and it's definitely one worth looking at if anybody's interested. Another thing that I've heard Nuttall say a couple times this year was that this could be the year where companies have paid off enough debt that they can start rewarding their shareholders with buybacks or dividend increases or whatever they want to do. And we saw that come to fruition with the Chevron news yesterday, because Nuttall came out with this video January 16th, and then of course now yesterday, which is later in January, and their $75 billion buybacks, 20% of their share float. So I mean, that is absolutely insane. What's your take on that? Do you think that's going to carry over throughout the sector, or that's just Chevron?
Oh, just fantastic news. Kudos to Chevron, because they have done two things for me. The first thing they've done is they've proven that even the blue chips are making so much money that they can afford to make these sorts of grandiose statements and back them up. Which, when you look down market, some of the companies are making even more money, right? So they've done that for me. And the second thing they've done for me is I was kind of wondering, okay, where can the oil supply come from? Okay, we talk about the oil sands, we talk about offshore, deep water offshore, not the easy offshore, but the deep water offshore, and the Middle East. Three places. The Middle East is kind of already spending what they want to spend. They don't have the reservoirs that they used to. They're depleting reservoirs. They also are moving offshore, so they're doing their thing. But the only companies that can explore or afford to spend deep water offshore and in the oil sands are the multinational companies. Chevron, Exxon, even like CNRL, Cenovus, we'll put them in there. They're about 1 million BOEs per day now, so quite big, 1 million plus BOEs per day. CNRL, Cenovus, Suncor, Imperial, Exxon, Chevron, Total, Eni, Shell, BP, etc. Chevron just they showed you they're not going to spend. The companies that can do these sorts of projects said, nah, we'd rather put our money to dividends. 36th consecutive year of dividend increase, by the way. We're going to put our money to dividends and buybacks. You can buzz off. You've told us we're dying. You don't want us. You don't want our oil anymore. You think we're polluters and all this. Okay, we're not going to explore. We're just going to produce what we have, and we're going to stay there. And hey, if you want us to spend more money, either re-rate our stock, or give us subsidies, or give us higher multiples. Right? It's as simple as that. So Chevron is the first one that's done this. I don't think the other companies are going to be as aggressive, but I still look forward to other companies now have this like pressure on them to sort of stop spending on exploratory projects and just go back into this shareholder returns, not forever, but for a year or two. Let the oil prices kind of get to a point where exploration is meaningfully profitable, and let the companies re-rate to a point where they actually hold some intrinsic value. So they've done these two things for me, which is really exceptional. And I look forward to the other announcements from the other companies and what they're going to do, and they don't have to announce 20% buybacks. All they have to announce is that we're not going to increase our capex budget by 50%, because that's what we don't need. As much as the world would love that and the consumer would love that, that's one of the things that's missing from the oil and gas investors' mindset. Is they just think as soon as oil prices go up, capex will start getting jacked up again. And if companies do that, the sector will lose its trust yet again at a time when it needs it the most. So, hey, I think the bad actors are going to get punished, although that jury is still yet to be seen.
Yeah, for sure. I just thought that was quite the announcement, and I thought I'd like to hear your opinion on that. Before I let you go, I'd really like to just hear a quick little blurb on Surge Energy, and I bring that up because it's your tied for second largest holding in your WhIte Tundra account, and also your largest personal holding. So, what is it about Surge that you like?
Yeah, so Surge is very similar to MEG, except in the conventional space and a bit more complicated, for sure. So, and by the way, on MEG, I forgot to mention this: 2+ years of tax pool coverage. Surge, 2+ years of tax pool coverage. So, the reason why I like Surge so much is that people look at Surge and they say, oh, they seem to be pretty fairly valued against their peers in this area. And they've got very similar characteristics. It's a 25,000 barrel per day producer, BOE per day producer. And I go, yeah, but just like I said about China, you have to dig deeper into Surge to find what's really going on. And there's two things that are going on. One is that they're drilling the best wells in their specific areas. So Southeast Saskatchewan and the Sparky, which is about now, I think about 70-ish, 75%-ish of their overall production. They're drilling some of the best wells ever drilled in these two areas. And how did they do it? In Southeast Saskatchewan, they bought companies in 2021 where private equity wanted out and had exceptional reserve life. These companies had delineated nice pools, but private equity just wanted out. So they sold to Surge, and Surge said, thank you very much. We will make the money off this throughout the cycle. And that's what they've done. They are drilling absolutely crazy wells in Southeast Saskatchewan that pay out. Some of them pay out in 40 to 50 days, and they pay out 4 to 5 to 6 times in the course of 1 year. So, looking really, really good. That's at a $85, $90 environment. If we go even higher, obviously upside juice to that. And then the Sparky. Surge has used regular drilling, horizontal fracs. They've used multilateral drilling. They've used step out. They've done delineation, and they've taken the basin from about 1,000 barrels per day to almost, I want to say 12,000 barrels now is what they have in the Sparky. So they've really grown it organically. Unlike Southeast Saskatchewan, they've delineated these pools, and when you find a pool, you get 5, 6, 7, 10 years of reserve life in that pool. So they have a monopolized ownership of the Alberta, Saskatchewan sort of Sparky belt, and they're just going to continue to make lots of money off this. Very nice, cheap wells, low geologic risk. The odd well comes on so strong that it can pay out in less than a month and pay out 7 to 8 times in a year. So bonus on top, and just looking really good from a technical, geologic, engineering standpoint, which I can really, really appreciate. And the second thing that they've kind of showed me is what I talked about earlier, that they have undeveloped land. They ended up buying a bunch of prospective land with 2D seismic, 3D seismic, adjacent to other pools. And they said, leave it there. Just leave it there. When the market starts rewarding growth, when the market starts rewarding exploration, we'll go in, explore, and grow. And also, by the way, our Sparky and Southeast Sask exploration is very cheap because it only costs us $1 to $1.2 million to drill wells, as opposed to shale wells in the Permian, which are $7, $8, $10, $12 million. Shale wells in the Montney, which are now getting up to $7, $8, $10 million Canadian, of course. Wells in the Cardium that are $3, $4, $5 million, right? there's a natural edge to having a cheaper exploration program and having higher upside because the pools are completely undeveloped. So I see these as things that are going to play out over time. Right now, Surge's PDP, proved developed producing 1P reserve at about a $73 strip is $24 a share. Today we're at nine something ish, and I'll say this right now because I want this on record, and maybe I can hopefully come back to this at some point in the future. But 2 years down the road, if Surge can prove out some of their acreage, the undeveloped acreage, and the reserve evaluators run things at a $90, $95, $100 strip, Surge's net asset value will be north of $50 per share for sure. It will be possibly north of $75 per share. So you can see the hidden value there that gets reflected as they A, develop their acreage, and B, as oil prices go up and that torque, that natural torque comes into the company. So very happy with my position. I'm holding long and strong, and kind of look forward to let the team do their thing. I love teams that are, for lack of a better term, geologic and engineering nerds. That's who I want working my heavy oil and medium oil properties, because hey, it's an engineers and geologist and a geologist cycle, as I've said earlier.
Yeah, it totally makes sense when you just come back to the start of the pod where you said it's all about the rock and it's all about the geology, right? So, you get the guys who know that business the best. Perhaps they're the best guys to run an oil and gas exploration company. Yeah, with that being said, I don't know if there's anything else you want to add, or you can just, if anybody's interested, where they can find your content. Or
Yeah, so I'm on Twitter at WhIte Tundra SG. I also have my website, whitetundra.ca. All my content is there, completely free. I don't charge for anything. So if you get a Twitter message saying I'm offering a mentorship program or something, it's not true. Everything is completely free, and I think for those who are maybe new to the sector, you're kind of wanting to know more. I have a macro session coming up here on Sunday. So we're going to talk about some of the overall supply demand factors that are going on, and then really dive deep into US shale. So I host seminars every Sunday or so, 2 or 3 or 4 Sundays a month, talking about different topics, and they're on Zoom and they're on Twitter Spaces as well. So please feel free to join in. And if there's any other questions, I'm on Twitter, or my email as well is on my website. Thank you.
Yeah, awesome. I'll make sure to tune into those for sure. And thanks for coming on again. I'll have to get you back on. There's so many more things that I need to talk to you about, but we only have so much time per episode. So yeah, we'll get into it again. Thanks a lot.
Yeah, you bet. No, thanks again. Great to be back.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.